Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Iman Syakirin. I will be answer the question number 1. So for the question number 1, we need to calculate the company liquidity ratio based on the statement that has been given and that has been answered by me. For the question number 1 Roman, we need to find the current ratio and the quick ratio because this is the continuation for the question number 1 to Roman. Okay. So to get the current ratio, we need to follow this formula, which is for the current ratio formula is a current asset divided current liabilities. Okay, to get the current assets, we need to find the inventory plus account receivable and plus the cash equivalents of the Dura LTDs. And for the current liabilities, we just need to find the account payable of the Dura's LTD. Okay, for the current assets calculations, the inventory of Dura LTDs is 1,245,509 plus the account receivable of Dura LTDs is 726,575 plus their cash equivalents is 77,916. And their own current assets will be 2,015,000. Okay, next let's move on for the next ratio, which is we need to find the quick ratio. Okay, for the quick ratio formula, we need to have a current assets minus inventory and divide it into current liabilities. Okay, so for the calculations of quick ratio, we need to have a current assets of Dura LTDs, which is 2,015,000 minus their own inventory, which is 1,245,509. We need to divide it into their own current liabilities, which is 575,000. So we will get the quick ratio of the Dura's LTDs is 1.39911 and the etc. And for the quick ratio of the Dura's LTDs, we got 1.40. Okay, based on the table given, we saw that the Dura LTD's current ratio of 3.57 times is below the industry average of 4.3 times. So this suggests that the company has less current assets relative to its current liabilities, so compared to industry peers. However, a ratio above 1 indicates that the company can cover a short-term obligations. For the next table is the Dura LTD's quick ratio. As we can see, the company's quick ratio of 1.40 times is significantly higher than the industry average of 0.97 times given. So this will indicate that the Dura LTDs has stronger liquidity when excluding their own inventory. With more quick assets, they're available to cover their own current liabilities than typical in the industry. The overall evaluation of the liquidity performance by Dura LTD, we can see Dura LTD presents a mixed liquidity positions, while its current ratio is slightly below their industry standards, and the quick ratio sustainability better than their average. So this shows that the company maintains a relatively high level of their own inventory, which is included in the current ratio but excluded from the quick ratio. Next, the strong quick ratio also indicates a good ability to meet immediate obligations without relying on their own inventory sales. So for the management, they might want to review inventory levels to improve the current ratio while maintaining the healthy quick ratio position.
Assalamualaikum, my name is Nurul Zainal and my ID number is BMA2307061, and I will be explaining about the question number 1, which is historical data analysis of Dura Ltd current performance. So for the answer is, in 2024, Dura Ltd demonstrate a moderated improvement in inventory management as the inventory turnover increased from 4.36 times to 5.01 times. This indicates that the company was able to sell and replace its inventory more frequently during the year. This might be because the company planned their stock either or improve how they manage supplies. Additionally, the day of sales outstanding, or we call it as DSO, show a slight improvement, decreasing from 35 days to 34 days, reflecting a marginally faster collection of receivable. However, both the fixed asset turnover and total asset turnover ratios declined significantly. The fixed asset turnover dropped from 6.2 times to 4 times, suggesting less efficient use of fixed asset to generate revenue. This might be because the company spent money on machine or building that are not being used much yet. Similarly, the total asset turnover fell from 4.1 times to 3.9 times, indicating a reduction in the overall efficiency of the company in utilizing its asset to support their sales. This could mean that the company has too much asset but sales did not grow at the same pace. Overall, although there were minor improvements in working capital efficiency, the company's ability to manage and utilize its asset effectively declined in 2024 compared to their previous year, which is 2023. So the company should review how they are using their asset and make sure that any new spending could help in increasing their sales. Next, I will explaining for the question number 2, which is Dura Ltd overall performance compared with competitor in 2024. From the comparison, we have seen that Dura Ltd has lower inventory turnover, meaning that its stock movement are slower than Embun.co and also Flexwell Corp. This may suggest that Dura Ltd has excess inventory or slower sale performance. For example, some product may remain too long in storage before being sold. Next, the days sales outstanding for Dura Ltd is higher, making it take longer to collect receivable and indicating more times is needed to collect payment from their customer. This could be due as to less strict credit terms or delay in customer payment. As a result, the company may face some of the issues such as cash flow issue in a short term. Moreover, fixed and total asset turnover ratios are significantly lower, reflecting to the Dura Ltd is less efficient in converting its assets into revenue than their competitor. This has shown that Dura Ltd indicating weaker efficiency. This might mean that the company has invested in building or equipment that are not generating enough sales. For instance, unused factory space or underutilized machine could lower this ratio. So, that's all for me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Qadrinada binti Muhammad Shamsuri and my ID number is PME 2307041. So next I will continue for the question number 2, and the question is it Dura Ltd keeping up with Embun.co and Flagwell Corp? So my answer is Dura Ltd is not keeping up with both, which is Embun.co and Flagwell Corp in 2024. It is because of their inventory turnover of Dura Ltd is significantly lower than both, which is Embun.co and Flexwell Corp. So that is a meaning can be slower inventory movement and have a possibility of excess stock of significant of inventory management. So that's all from me. Thank you. For the point number one is a usage policies, like prevent misuse or overuse. So it's help that everyone know how to use asset properly. So for the point number two is a maintenance schedule, like routine and preventive maintenance extend asset life. So for the point number three is a disposal policy, like properly retire a recycle, unused or end of life asset. So for the number two is exchange life cycle management. For the point number one, like monitor asset for from acquisition to disposal. So for the point number two is perform regularly evaluation to decide whether to repair, upgrade or replace. So the last one is use total cost of ownership to inform decision, not just purchase the price. So that's all for me. Thank you.
Assalamualaikum. My name is Adina Marisa and I am from DEN6C, and today I will answer the question number 3. So the first question is, how would you assess the health of Dura Ltd's debt management in 2024? In order to evaluate Dura Ltd's debt management in 2024, we must take into consideration if the company effectively used its asset to generate returns, manage liquidity well, and stays free from an excessive reliance on debt. In 2024, Dura Ltd demonstrated a slight improvement in its working capital efficiency. For example, the inventory turnover ratio increased from 4.36 times in 2023 to 5.01 times in 2024, reflecting improved inventory control and faster transformation of inventory into sales revenue. Moreover, for days sales outstanding, Dura Ltd reduced slightly from 35 days to 34 days, which can improve liquidity because company quickly collects money from its customer after making a sale on credit. However, a decline is observed in the fixed asset turnover, which is 6.2 times to 4 times, and total asset turnover 5.1 times to 3.9 times. These drops indicate inefficient usage of fixed and total assets for generating revenues. Inefficient usage, inefficient usage of assets might lead to lesser cash inflows, which can further impact the company's ability to repay debt. Hence, Dura Ltd's debt management in 2024 may be risky and require attention to improve its overall financial stability. Next, I will continue with the question number 2. Why is healthy debt management important for the long-term continuity and sustainability of a business like Dura Ltd? The first one is it helps a company have more money to grow. When debt is under control, the company can use its profit for expansion, improving operations, or launching new product instead of just paying back loans. Next, healthy debt management can stabilize cash flow by making sure that debt repayment, including interest, do not strain operational liquidity. This allows a business like Dura Ltd to fund its daily operation without interruption. Thirdly, healthy debt management helps the business to avoid financial distress, especially during periods of economic uncertainty. This can also safeguard the company's reputation and stakeholder interests. Stakeholder and investor they will feel more confident because the company is financially responsible and well managed. Lastly, healthy debt management can maintain bank and investor trust. Bank and investor are more likely to support a company that manage its debt well. That's all from me. Thank you.